welcome to another episode of Crypto Conscious. My name's Lockie, and today I'm going to do a video about, has Australia passed bail-in laws? There was a bill that just passed in the Senate on the February 14th, and there's been a bit of an outcry from some people that have said that this means that governments or Australian government can now operate on these bail-in laws. So I wanted to do a video to help clarify exactly what this bill means and how it impacts any depositors in banks in Australia. So I'll start with a bit of a definition as to what a bail-in is, because some people may not know. Now, a bail-in is rescuing a financial institution on the brink of failure by making its creditors and depositors take a loss on their holdings. Now, a bail-in is opposite of a bailout, which involves the rescue of a financial institution by external parties, typically governments using taxpayers' money. So typically bailouts have been far more common than bail-ins, but in recent years, after massive bailouts, some governments now require the investors and depositors in the bank to take a loss before taxpayers. Now, both the European Union and the US have restricted the use of government bailouts now, which effectively makes bail-ins default options for banks in distress. The sentiment behind it was that taxpayers should not have to pay for the big banks' mistakes. It became a source of resentment that during the financial crisis, governments paid trillions of dollars of taxpayers' money to rescue the big banks, while the ordinary people lost their jobs and homes. So an example of this was in Cyprus, which the practical consequences were that uninsured depositors defined in the EU as people with deposits larger than 100,000 euros in the Bank of Cyprus lost almost half of their deposits, and in return they received stock in the bank. However, the value of these stocks were nowhere near most depositors' losses. And uninsured depositors in Lakey, the nation's second largest bank, lost everything as the bank failed. So some background as to why this bill has been passed in Australia. Ever since 2009, basically any sort of the governments across the world have been looking at ways to obviously effectively manage crises. So if a bank was to fail, and a few of the areas that they've really clued into is guidance on legal powers needed to respond effectively to financial institution distress, to create policies and processes to respond to financial institutions' distress in ways that minimize or avoid taxpayer assistance, and frameworks for managing cross-border financial institutions' distress. So that was the framework that some of the areas that they've outlined. But at the conclusion of the Murray inquiry, which was an inquiry into Australia's financial system, some of the recommendations which really pertains to this new bill is of this. So loss absorbing and recapitalization capacity. So the recommendation is to implement a framework for minimum loss absorbing and recapitalization capacity in line with emerging international practice. And also sufficient to facilitate the orderly resolution of Australia's authorised deposit-taking institutions to minimise taxpayer support. So the key to this is basically it's wanting to bring Australia up to international standards when it comes to obviously crisis resolution. Now, to understand that, we have to look at what the international practices are, and Great Britain and the European Union, New Zealand and the United States already have bail-in laws in effect. So it's not too far-fetched to believe that these laws would be now passed in Australia, as our allies and equally considered economies have these laws in place already. So the summary of the bill that's just passed was the Financial Sector Legislation Amendment, or Crisis Resolution Powers and Other Measures. So the summary is the Financial Sector Legislation Amendment, Crisis Resolution Powers and Other Measures Bill provides the Australian Prudential Regulation Authority, or APRA, with the enhanced suite of crisis resolution powers applicable to prudentially regulated authorised deposit-taking institutions, or ADIs, general insurers and life insurance companies and certain group entities. So it's given these APRA the ability to go into banks, credit unions, insurance companies to take effect if they believe that a crisis is about to occur. And the key issue with the bill was the wording in terms of APRA's ability to write off provisions for these companies. So they define it in section 11 CAA as conversion and write-off provisions means the provisions of the prudential standards that relate to the conversion or writing off of A, additional tier 1 and tier 2 capital, or B, any other instruments. And by this it means is that when APRA go in to help obviously protect the institutions from failing, what it does is it writes off certain bits of capital to basically help keep that bank afloat. And with B, any other instrument, that would by interpretation define depositors' money in banks. So this is why there's been a lot of issues with people objecting to this bill, is that any other instruments doesn't clearly define what sort of capacity they have to write off depositors' monies. So can section B interpreted to include bank deposits as an instrument that could be converted or written off? So the Treasury has actually responded, and the way they've responded is to say that the Financial Claims Scheme is an Australian government scheme that provides protection to deposits in banks, building societies and credit unions, and to policies within general insurers in the unlikely event that one of these financial institutions fails. So what this does is it protects depositors are protected up to a limit of $250,000 for each account holder at each bank, building society and credit union that is incorporated in Australia. So the FCS can only be activated by the Australian government, and APRA is actually responsible for administering the scheme. So what does it mean? Now, the bill does not clearly exclude depositors' funds from being considered an instrument, which is what the objectors were hoping to have rectified in the bill. But that wasn't the case. Instead, what they've done is they've actually reworded the bill slightly to say that APRA's statutory objectives include protecting the interest of depositors and promoting financial system stability in Australia. Now, the issue that this causes is in the event that depositors' funds are required to promote financial system stability due to a bailout not being an option, this creates the grey area as to, well, what instruments of capital would they use? But it's left to interpretation, though, that the FCS's $250,000 insurance guarantee is still valid, and APRA actually don't have the ability to adjust that themselves. They're just the administrator. The government themselves are the ones that control the $250,000 insurance limit. However, if the government was to adjust that insured amount in an event of a crisis or something like that, there's now a really strong framework in place that would allow APRA to really allow for this bail-in scenario to come into effect. But that's just only half of the problem, is that now that these laws are in effect, it does affect the other areas that were mentioned and clearly defines. Now, AT1 and T2 capital actually represents, in the eyes of the Treasury, $80 billion in regulatory capital. So the majority of people that have bought into these AT2 capital is in the form of hybrid securities. Now, hybrid securities are actually available to mum and dad investors and retail investors, and there's a bit of contention about whether it's been clearly explained how risky these are. They're considered a high-risk investment, but also self-managed super funds. So those that have invested in hybrid securities, in the event of a crisis, APRA have the ability to go in and to use that capital to write off. So anybody with hybrid securities should be highly aware that this is possible. The other thing, though, is anyone that has an excess of $250,000 in a bank in Australia should also be cautious as well. So this particularly is for people like retirees and stuff that have that excessive amount there and generally keep it in one place to maximize their return. But what it does state is that you can have it in separate banks. As long as the banks aren't linked, you can have $250,000 per account per bank. So a little bit of a loophole there for anyone that wants to keep their money in Australia. Now, this is all good and well, but the purpose of these laws is actually only in the event of a crisis. So why would we worry that these laws would even come into effect if people perceive the economy being quite strong and the financial system being stable? But many feel that it's quite stable, but there's also a lot of information that are red flags that are popping up about the Australian economy, which we'll discuss a little bit, just to give you an idea of why these events could happen in the nearer future than many people think. So the first big flag is the Australian's banking sector has a heap of market capitalisation in terms of Australia's overall market. Australia is actually the only country that has been able to maintain greater than a 20% market share of the entire market by the banks. As we can see here, predominantly as people have reached the 20% of the market share, they've actually dropped very, very quickly. So we can see Sweden back here in the early 90s, when they reached that 20% market capitalization, they couldn't sustain it, and it obviously caused a crash. It happens again and again. We can have a look at Japan in 95, or just thereabouts. Same thing. As it's gotten to 20%, it's a massive decline. You can see it in the UK here. We can see it in the Eurozone here. And Australia is the only country that's been able to sustain this. But there's concerns when we could explore that. So for a bank to keep sustaining 20% of total market cap, the bank needs to keep generating increased income. And in a world of low rates, this entails an expansion of their assets. Now, however, there's only so many financial assets that the home economy can generate before saturation kicks in or the asset quality deteriorates. So that in itself it's as we're starting to see, if we look back, it's starting to deteriorate already, which is a red flag for foreign investors to not put their money into Australia. Now, the other aspect is our housing bubble. Australia, in terms of housing prices in relation to income, is at an all-time high across the world. We've got Sydney, that's the second most expensive city in the world to purchase houses in relation to income. We've got Melbourne, the fifth. Adelaide, Brisbane, and Perth, all in the late teens. And we can also see here that housing prices has continued to increase exponentially since 2000. Now, this only goes to 2010, but there was a slight stabilization for a few years, and then housing prices have continued to increase again. Now they're at a sort of a peak at the moment. We also see that housing prices continue to increase, and it's not congruent with the increases in our income. So people it's continually accentuating the cycle that houses going up and we can no longer afford to pay for them based on our incomes. And we can see the stabilization that was caused in the market in terms of lending just after the GFC happened here. It stabilized while people were wondering what's going to happen with the economy, and luckily Australia was able to mitigate a lot of its issues during the last financial collapse. But as we can see from 2012 onwards, it sort of really boomed again. So lending has continued, and it's just continuing this parabolic move, which we can see. And if you understand obviously how market cycles work, when we see increases like this, it has to come to a point when it collapses. The other scary thing of banks is how heavily the mortgage market weighs in on these banks. We look at America when they had their housing collapse. Home loans and equated to 15% of the assets of the banks in the USA and 17% in the United Kingdom. In Australia, they equate for 40, or home loan or mortgages equate for 49% of the assets of banks. So if the housing market has any instability, which is highly likely in the coming years, the net effect on the banks is huge. And we can see here that as of 2015, mortgages continue to account for more than 60% of our major banks' earnings, as these figures here are a little bit outdated. So what's going to happen with this housing bubble? Well, Professor Ross Gannott, whatever his name is, who's a chief economist, basically he said that his unequivocal view is that Australian house prices have been driven primarily by speculation. And we know what speculation does is it eventually gets to the top of the market and it collapses as part of the investment cycles. He's also skeptical that there's any actual housing shortages, which has been part of the reason why there's been this continued growth in the housing market, is this illusory sense of housing shortages. But if we look at past examples, in Ireland, California, the UK, and in Hong Kong, just before their housing markets crashed, they all reported that there was a housing shortage. So just because there's a perceived housing shortage doesn't necessarily mean that it's going to protect the market in the event of a collapse. So some key things to worry about with the housing bubble is the key factors that would make the housing market or the bubble pop is if interest rates increase, if unemployment rises, or the population itself decreases. Some scary things is that staggering 35.4% of home loans in Australia are interest only. So they've got no equity within their loans. So that's a lot of home loans that if in the event that obviously this bubble pops or interest rates increase, they're not covered with equity. Or if the housing market declines and the prices drop, then in turn they're even less have less equity and they have no equity at all. So interest loans in Australia typically have a 5-year horizon and to date have often been refinanced. If this stops, then the repayments will soar, adding the mortgage stress, delinquencies, and eventually foreclosures. There's also troubling suggestions that the leading use of unsecured personal loans is for a mortgage deposit. So borrowing money to borrow money, which is very, very scary. And in terms of how are people paying for these mortgages as well, more than 50% of typical Sydney residents' income is going towards mortgage repayments and 40% for Melbourne as well. So people are putting large proportions of their income towards mortgages, and this has really caused a lot of stress for homeowners. And again, all it requires is slight interest rate increases, repayments then increase as well, and it pushes a lot of people into situations that they can't really handle. The other thing too, which is not really spoken about too much, is the Australian mortgage market has ballooned due to banks issuing new loans against unrealised capital gains of existing investment properties, creating a $1.7 trillion house of cards. So to explain what this means is people are using equity within especially their investment houses to purchase new investment properties in which the overall debt far outweighs their income. So the model though is as long as housing prices continue to increase, there's no issues. But the problem is as soon as these houses decline in value, so does the rental return, which then doesn't allow them to substantiate the massive amounts of debt that they've created for themselves. So in turn, as soon as the housing market declines, then in turn those people that have really overdrawn themselves is going to cause a massive issue. The other thing too is humans tend to exhibit herd behavior. So during a boom, they suffer extreme fear of missing out, or FOMO. And when there's a bust, almost everyone rushes for the exit at once. So as we can see, so many people have bought houses during this boom with the ideas that the housing market is going to continue to increase and increase. Well, the issue is though, as soon as that declines and people unfortunately see that the housing price is declining, we see a mass sell-off as well, which causes these market cycles and boom and bust scenarios. So how safe is Australia's banking system? Well, 50% of Australia's mortgage market is held by the CBA and Westpac, and as of December 2009, which is a little while ago, 60% of CBA's lending books are mortgages. So the banking system is highly built on obviously our housing market. And the scary part though is if you look at in 2009 for CBA, the leverage ratio is almost 20 times. So they've only got $31.4 billion in equity, and they've lent out $620 billion. So this means that only if 6.6% of their loans go bad, it means that any loans, not just mortgages, 100% of shareholders' equity will be wiped out. So Australian banks have $13 trillion of off-balance sheets liabilities, which is a huge amount. So that leads us to how expensive would a bailout scenario be, which is the opposite scenario to a bail-in. So we need to weigh up both options in terms of what do we think is going to happen. So back in 2009, and these figures have increased, Australia's net foreign debt was $648 billion, and Australia's personal debt was $1.2 trillion. So really, if one of these failed, the Australian dollar will tank because, unlike America, it's not a reserve currency. It hasn't got oil backing it. And what happens then is basically inflation soars. As inflation soars, it devalues the currency, which is a really important aspect to it. So particularly in smaller and more open economies, example Australia, pressure on currency could force central banks to follow a tighter policy than would be warranted by domestic economic conditions, example falling house prices. So that means that Australia will have rising interest rates, rising unemployment, rising inflation, and falling house prices, which basically screws everybody. So private debt is through the roof. People have borrowed so much money. We can see it's just continued to increase and exponentially since the early 90s, and it's going parabolic. The debt is people borrowing to help substantiate their lives, and unfortunately it gets to a point where it can no longer be substantiated because obviously our income our wages aren't increasing at a relative rate to support this. So basically it's a matter of when, really, as opposed to if, and unless there's drastic measures taken. So when will it happen? No one really knows, and that's the key. Is it may not happen for a year, it might happen for 2 years. It could happen any time in the future. But if it does happen, how prepared are you, and what could you do to prepare for this crisis? So some key things that you can do is you can actually profit through these scenarios as well, which generally is what happens from major corporations and institutions. Is firstly, avoid debt wherever possible, credit cards and mortgages particularly. Diversify yourself, so you can put yourself into foreign currencies or digital currencies such as Bitcoin, which then you'll actually make increases on your assets or your dollars that you have as the Australian currency goes down. So until you actually be making money by hedging your portfolio elsewhere. You can also invest in precious metals such as gold and silver. And the other interesting one, which if you're a real bit of a cowboy, if you're really bold, short the banks. So as we can see, Westpac and Commonwealth are the ones that have the major proportion amounts of lending. So in the event that these markets collapse, do what the big corporations do, and you can short those banks to make even more profit as well. So again, this is just to give you an idea of what could happen in the event of a bust, and give you some ideas as to potentially why we could see how obviously these financial institutions and the whole market collapse, and what you can do to protect yourself as well. Now, with everything, take my advice as a grain of salt, because I'm not an economist. This is just my interpretation of it. But a lot of economists, and especially Professor Steve Keen, who's a brilliant economist, if you wanted to really look into what he speaks about, he'll really explain that he really believes there's a high likelihood of another market financial crisis happening very, very soon. He was actually credited as the first person to pick the GFC. He picked the GFC that happened in 2008 back in 2005, and has been widely accredited as the person to predict it most accurately. And he's predicted another one to happen very, very, very soon. So hopefully that's provided a bit of clarity for you as to where things stand. And look, I hope you've enjoyed it. And if you have any questions, I'd love to hear from you. But otherwise, see you next time. Thanks.